All right. Well, thank you for joining us and welcome to Raising Capital in 2024. This is part 2 about commercial and alternative debt financing. Before we get started, Naturally Bay Area would like to thank our generous partners. Their contributions allow us to bring you this educational programming and create opportunities for community building. Additional thanks to our company members for contributing to our vibrant community. And now I'm pleased to introduce you to today's moderator, Naturally Bay Area board member, Don Booter. Don, I'll hand it over to you.
Thank you, Monique. So my name is Don Booter. I'm on the Naturally Bay Area board, as Monique mentioned. I'm a partner at Davis Wright Tremaine, a national law firm with a large food and beverage practice. And this is the second part of a two-part series we've had for Naturally Bay Area on raising capital. The first was about raising equity in this business environment, and that session occurred about a month ago. I think it's still available online if you want to listen in to that. And this session will be about trying to obtain debt financing for food and beverage or consumer product companies in this environment. And the way we structure this is as a conversation. We have three excellent panelists here who represent three different perspectives on this issue. The three of us will have a conversation for about 35 or 40 minutes, and then we'll leave the balance of the time for Q&A if there are questions to pose. And then we'll have a hard stop at 12:45. So with that, I'm going to ask each of the panelists to introduce themselves and tell us a little bit about their backgrounds and the companies they are with. So Lisa, can we start with you?
Yeah, hi everyone. Thanks for joining. Lisa Curtis. I'm the founder and CEO of Kuli. I have been running Kuli for, believe it or not, more than a decade. I first started the company after working with this amazing green superfood called Moringa in the Peace Corps, and slowly but steadily have built Kuli up into a leading functional food brand. You can find our products in 11,000 stores nationwide, everywhere from Whole Foods to Walmart, many retailers in between. And I joke, not joke, that I have literally raised every type of capital there is and have probably hit up everyone you know for money at some point along this journey.
Fantastic, Lisa. Thank you. Keith, can you go next?
Yes. Hey, good afternoon, everybody. Thanks to Naturally Bay Area, Monique, Don, and all the staff there for inviting me today. I'm really pleased to be here with all of you. My new venture serving our space is CPG Financing. CPGfinancing.com is my website in development, coming soon, I promise. And I'm also the author of this little book, CPG Financing Guide on Debt Financing, where I chronicle all the different types of debt financing that I've seen that's available to all of you founders in different stages of your journey. From startup and early stage, where probably a lot of you are, to the growth and pre-profitability stage, where probably some of you are, and then to later stages, break even to profitable, and even multi-year profitable. And the best way I can support founders is I have a call called Your Financing Review, yourfinancing.com. It's a free 30-minute strategy session. What you'll leave with is a full debt-led strategy for financing your business. And I also advise on equity structures as well for a holistic view to fulfill all your cash needs into the next 2 to 3 years.
Terrific. Thanks, Keith. Anderson?
Good afternoon. Thank you, Don, and thank you, Naturally Bay Area, for the opportunity of being here. My name is Anderson Silveira. I'm a senior relationship manager with Bank of America here with the North Bay team. Our business banking team works with companies from startups to 100 million. As a senior relationship manager, I work typically with companies from 10 million to 100 million. And I'm their business banking advisor for their cash management solutions, which helps them speed up receivables, manage payables, as well as provide fraud solutions. We're also a big lender, as you know. So we assist with commercial real estate lending, equipment financing, as well as operating capital. I've been with Bank of America for 5 years now, but been in the banking industry for about 20 years. I'm originally from Brazil, but moved to the North Bay back in 2002 and been here since.
Terrific. Thank you, Anderson. So as you can see, we have three very different perspectives here. A founder who has been in the trenches very recently, raising commercial debt, a lender, a large commercial lender who is involved in this on a day in, day out basis. And then we have a strategic advisor who advises companies on how to proceed in raising debt financing. So three very different perspectives, all very valuable at the moment we're in. So let's set the frame, Keith, if you would, by talking about the business environment that we're in now for trying to obtain commercial debt. We're coming out of the pandemic era. We're heading through a presidential transition. We just completed an election cycle. How does that all affect where we are right now in terms of commercial debt and its availability for emerging companies?
Yeah, thanks. A few touch points, I think, that for the consideration of everybody. We've seen that inflation, at least measured at the macro level, has come down a bit. It's interesting that data reveals in consumer behavior that normally people need to see that over an extended period of time before they feel that it really is meaningful to them. And the idea is 12 months of more normalized inflation before people begin to think that it's not really something highly affecting them. Additionally, we've seen interest rate cuts. The jury is out about further interest rate cuts. Certainly Anderson would have more perspective on that as well. My observation, if you look at how debt evolved during 2024, in the broader categories of commercial, alternative, SBA, fintech, private sources, and even family offices, is that there's been a large-scale tightening. And a tightening meaning it's harder to qualify. And the credit box, which means, again, what are the underwriting criteria that people use to decide yes or no, in addition to the terms and covenants, have gotten more restrictive. So it's harder than ever to qualify for debt. I have seen some notable exceptions of ones that have actually loosened their credit box. Interestingly, that's been in the e-commerce space, but the retail sector is tight. And I think, though, that for all of us here, the most important things that anyone can do to think about being ready for debt financing is, right off the top, having your books clean and updated and ready to go at any moment, making sure your personal credit looks good. And then I'll add just one more dimension that increasingly came up this past year, but not in the past, is your business credit. SBA lending, particularly at the entry point, is looking now at business credit scores as much as personal.
So at least in Anderson, do you have the same perspective that it's a very tight market and a challenging one? Lisa, we'll get into your personal experience a little bit later, but I'm curious about your kind of overall vision and perspective on the market.
Yeah, I mean, I think my spin and sort of ad would just be, it feels like we're going from the unicorn era to the camel era. Like I've just seen the conversations change so much from like, how fast can you grow? How fast can you grow to how quickly can you become profitable? And it does feel like, given the amount of capital locked up by, all of these unicorns who can't quite IPO because they're afraid of what the market will do, you just see that downstream effects in the equity market. And I think there's a lot of companies kind of in our space that are turning to debt as an alternative. And certainly from our conversations with lenders, the first question they're looking for is, are you profitable, or can you get there in the next few months?
Anderson, from 30,000 feet, what's your perspective on where the market is?
Yeah, I think there was a couple of key points there that we can touch on. As a traditional bank lender, we look at cash flow. That's the first point. When you go to a bank, they're going to want you to be profitable, at least 2 years profitability. So the high interest rate environment coming into 2024 certainly impacted some of those companies' ability to qualify for debt. As Keith alluded to, those rates have come down a bit. We should see that coming down a little bit more, and that will ease the entry point there and the ability to qualify for more debt. Another point that Keith mentioned as well was the bank's underwriting box. A lot of that was due to 2023. We saw some bank failures, capital reserve requirements were increased. So some banks have tightened their credit policy, their credit box, right? So what they were approved in previous years. They might not be renewing. Luckily for Bank of America, we didn't have that requirement. We still stand strong. We're pretty aggressive in the market. And what I'd say to the audience is, I think it's key that you know who you're working for, or the banker you're working for knows you, because the numbers tell the story, but the bank associate also needs to help tell your story in order to get you approved.
Thank you. So Anderson, just to continue on that, the commercial banking thread for a moment, how is commercial banking looking at the food and beverage sector now in ways that it might be looking differently than at, say, tech or other sectors of the industry? Is there anything unique or special about food and beverage that's either appealing or concerning to commercial banks?
Yeah, I can speak for Bank of America. I can't speak for every commercial bank, but what I can share for us, the food and beverage industry is a high appetite industry. We like it. In speaking with a commercial officer yesterday about this industry, she shared that we see a good demand still in this industry. One of the concerns that we had coming into 2024 with this inflation, with the higher inflation, was how is that going to impact the margins for these companies? But from what we've seen so far here in the Bay Area, especially in the North Bay, is that a lot of these companies have been able to pass that increase on to the consumer, and their demands continue to be strong. So it hasn't impacted them. In fact, we're financing growth for these companies. We're financing expansion into new markets. So for us, we see a good market, and we have a high appetite to continue lending to this market.
Any other perspectives on that issue, that question of commercial banking in our market? Keith or Lisa?
Yeah, I think I'm glad to hear that Anderson and the Bank of America still have that high appetite. I've seen others perhaps shrink their appetite just because the observation, particularly on P&Ls, of seeing the increased amount of money going to trade spend and other and supply chain issues still, and freight costs and things like that, higher costs mainly in the cost of goods sold area, which dampen the chances or the ability for people to manage the profitability, or better said, make it more challenging for sure. And so I think the other thing I see that some banks struggle with, or anyway, across the board financing sources, is some people are just better at intuitively understanding retail, and others are better at e-commerce, particularly in the fintech space. So many sources, financing sources, have developed specifically to finance e-commerce. And I think there's an opportunity for people to broaden their perspectives to understand a bit more about what omni-channel really looks like.
So, Lisa, if we could turn to your experience now, recent experience with alternative lending sources. We'll get back to the conversation about conventional commercial lending, but your experience has been very unique, and I congratulate you on being very successful in pursuing these avenues. Could you start by telling us a little bit about where Kuli is, and why you think you were able to obtain this non-conventional alternative financing, and the kinds of sources you look for, what the process looked like?
Yeah, absolutely. So just like at a high level snapshot, we've raised about 12 million venture and about 3 million debt. That's where we are now. That's obviously not where we started. I think that the interesting thing about CPG, in my experience, I've really found the $1 million per head for profitability rule to be true. The idea that, you need $1 million in revenue per person on staff, which just means at a small scale, it's really, really hard to be profitable. So, transparently, it has taken us a decade to hit profitability, which means that for the majority of our time, commercial banks haven't really been an option. So we've had to get fairly creative. I think for us, one of the sort of interesting ways that we've found lender partners has really been at thinking about, what are kind of the different values that we're bringing, and where are there, kind of uniquely targeted sources of capital. So one of the things Kuli is very focused on is working with smallholder farmers, pulling people out of poverty, and really investing in our supply chain. And so two of our lenders, one of them is Kiva, one of them is Kenny Earth, which is a family foundation, specifically focus on that. And they've been able to provide us with like very affordable debt. And so that has certainly helped us quite a bit. And for Kiva, I think part of it is building that relationship over time. We started with a $5,000 loan in 2015, and now we're at $600K. So it really, really has been kind of like a building trust. And then we also have a loan through Whole Foods Market. And I think, there are lots of retailers who are kind of interested in thinking about how do we support, invest, lend, kind of support brands in different ways. So that can be another avenue for debt financing as well.
So, Lisa, the process with either Kiva or Whole Foods Market and the length of time involved, their underwriting areas of focus. Could you talk a little bit about that?
Oh yeah, so much time. One of the things I often tell other founders is like, I talk to my investors once a quarter. I talk to my lenders as much as I possibly can, because I think from a lender perspective, you want to know exactly what's happening in the company. You want to like stay really tightly on that. And the more you see progress, on revenue, on profitability, on just kind of like overall business success, the more likely you are to like continually increase that amount that you lend. And that has certainly been the case for us. I mean, we, with Kenny Earth, we started talking to them and sending them quarterly updates, I think like 3 years before they actually lent us any money. But they ended up lending to us in April 2020. So like, thank you to them for not pulling back and feeling like they understood us well enough that they still felt confident even amidst the pandemic and everything else. And then I think the other benefit of like having really tight relationships with lenders is more recently we have had some very exciting launches. We're launching into Target and Kroger and expanding with both Walmart and Whole Foods next year. So our business is effectively doubling next year, and it's all hitting in Q1, which is amazing and terrible at the same time, because it means that we are like building up, $2.5 million of inventory in a 6-month span. So we were able to go to them and just say like, this is what's happening. These are the POs, these are the confirmations. And they actually could, kind of snap their fingers and give us another $1 million on our working line of credit. So I think when I think about lenders, I really think about like, what are long-term relationships that you can build such that they understand you, they understand your business, and they can be flexible. And, as the business scales, hopefully they can like scale with you.
Anderson, Keith, any additional thoughts in that regard?
Yeah, I really like what Lisa said there. I think it's so crucial that you are talking to your lender, especially when it comes to a traditional bank. As a relationship manager, I go to the business, but I have to be able to tell the story back here. So the more information you share with me, the more I can share. I can explain why is it growing so fast, and why should we be comfortable that that's going to remain that way, or explain to my risk that you're not going to just come back down. So the more you share, the more contact you have, the easier it is for the banker to be able to tell your story.
Yeah, I'd like to build on that too. And I really want to witness Lisa, because a lot of founders, I think through either money stories, limiting beliefs, or other trepidations, might not feel as comfortable being that proactive in their communication for a number of reasons, including maybe even feeling like, well, what if they judge me harshly? Or what if they think that what I'm telling them changes their willingness or desire now or in the future to give me more money. And yet I think the opposite is true, is that someone like Anderson or others are going to get excited about how can they support you more into the future. And they and the lenders and other financing sources can often be the ones saying, wow, Lisa, thanks for letting me know. Now we can perhaps think about doing this instead. And although we started on this path, now we can look at this one, because the one thing we certainly know, everyone in the room with CPG founders, is it's not a straight line. And the only thing we know about your projections is that they're wrong because it's going to be something quite different from where you go. So making sure that that communication and being proactive rarely results in anything bad or adverse action, as they often say in banking. And I think it's just really cool that you're very at the forefront of communication. And if I could just record that soundbite and play that to my email audience, that would be incredibly valuable, because this is still relationships. And these are still people that I think everybody is excited to support a founder's growth and success story.
So Lisa made another very important point that I want to bookmark, which is that raising capital, either equity or debt, is long-term agriculture. You have to plant a seed well in advance of when you're actually going to ask for the money. If Lisa started this process with her lenders 3 months instead of 3 years before she needed the capital, the debt, and she wouldn't have been as successful. So, and lenders as well as investors are willing to invest time in getting to know you and understand you and be ready to answer your request when they are comfortable with you. So investing in that long-term agriculture is something that every founder should be doing all the time, whether you need the money now or think you'll need it in a year. You have to plant those seeds along the way. So Keith, could you tell us a little bit from your perspective about what sectors within food and beverage seem to be getting the most positive response to commercial lending requests? Are there sectors or categories in our industry that seem to be getting traction in commercial lending?
When I look broadly at food and beverage, I don't see any particular trends that say one type of favor is favored over, or one type of sector is favored over another. That said, one of the ways that I've tried to educate my lenders who are either new to this sector or continue to grow their knowledge is understanding the difference between those that are more logically fast growing, such as snack and beverage, and those that have higher capital requirements, and why. There are certainly some sectors that are more prone to be 100% retail businesses, and therefore the whole trade spend, all the investments required there. There are some that are more prone to be e-commerce. So I think, again, it's really quite case specific, and it's just really my job to point out to any particular financing source is how do they typically operate, how that's migrating and changing, and if there are some externalities, macro factors or internal things that have happened that could affect their way of analyzing something to go beyond perhaps the typical algorithms or ways they underwrite.
Okay. So I'm going to skip around a little bit in some of the questions that I wanted to address with each of you, but I'd like to talk now about the key metrics that lenders look at in evaluating a prospect for commercial loan in food and beverage. So Anderson, could you talk to us as a traditional banker what the conventional metrics are?
Yeah, certainly. And I think part of that will add to Keith's response there on the products, because collateral is key when we're looking at lending, right? So before I go into the key metrics, I'll just share when we're looking at product category, I think shelf life is important because that's our collateral. So the longer shelf life, the better. Traditional lenders, Bank of America, we're a federally chartered bank. So CBD products, that's a non-starter for us. And then as far as when we're looking at lending, first source of repayment is always cash flow, right? So that's why we usually ask for 2 years profitability. The more profitable you are, the likelihood of the chances that we can lend to you and we can lend more to you. Once we establish the cash flow, then we look at the second source of repayment. That typically is collateral. So if we're doing a real estate loan, the real estate will be the collateral. We can fund up to 80% financing on that. If it's an SBA loan, SBA can fund up to 90% financing for that. Equipment, we use the equipment as our collateral. We'll typically go 100% of that equipment. And then it comes operating lines of credit. That collateral, we look at the accounts receivables. So the company's accounts receivables, up to 80% of the less than 90 days accounts receivables. We exclude some of the concentrations above 25%. And then inventory is the other collateral for operating lines of credit. And typically, depending on the shelf life, that's why it's important, the shelf life. The longer shelf life, the larger advance rate we can give. And lastly, the guarantor support. So the stronger the guarantor, it helps us mitigate some collateral shortfall or get more comfortable with the deal. Ideally, the guarantor, if they have large liquidity, then it's easier for our risk and our credit officer to sign off on something.
So these are personal guarantees that are typically
Correct.
sort of the founder. Right?
Mm-hmm. And a big thing on personal guarantees is, you're just standing behind the company. The bank will go out, won't go after your personal assets. I mean, I've never seen it, but typically, we're after the business. We're going to sell the inventory, collect the receivables, or the real estate. So a lot of times, some people get concerned about doing the personal guarantee, but it's more of a stamp of approval that you're standing behind your company, and if the world collapses, yeah, you are guaranteeing it.
Got it. Lisa, did your underwriting process with the alternative lenders differ from what Anderson is describing?
All the fundamentals for sure. I think we tried to pull levers harder in certain places. So inventory for us being, a supplement company with like shelf-stable powders, 2 to 3 year shelf life, we really tried to pull hard for like 80% inventory. It also is, as a business sourcing internationally, we place POs, we receive product 8 months later. So inventory is just kind of like our key. And then personal guarantees are something that we have negotiated out whenever we can, just for like peace of mind. It does just cause a lot of stress, even though everybody says on the lender side they'll never actually use it. In most cases, we've been able to get those removed. In one case, we have not.
So Keith, what's your perspective on these questions of the key underwriting issues and personal guarantees and the like?
Yeah, thank you for that. And I think adding really to what Anderson and Lisa have said, one thing I'd encourage people to think about is kind of the window that they're looking at to determine what's available. So if people are saying, hey, in order for me to make a credit decision about how much money I'm giving you, I'm looking at what you've done up to date and in the past, right? So oftentimes, particularly in commercial lending, SBA lending, places like that, they'll be saying, I want to see your tax returns. I want to see your year-to-date financials. They're looking at what you've done with sometimes a little bit of an eye to the future with projections. In the alternative space and in the fintech space, a lot of times they're looking at the past, maybe not as long in the past. They're more future oriented. So for example, if you're looking at working with how to finance against your accounts receivable, they're more interested in what are you going to do? What are you going to do, in the next 12 months? How much money will you put through a deal? Same with inventory. Fintech will often say, okay, great. I want to see what your results were, but I'm more interested in understanding what is your cash runway that you have on hand and how far will that take you into the future? And that's a particular metric which I've seen tighten. And tighten's kind of an odd word for it, because what I really mean to say is they're actually needing to see a longer amount of cash runway available to you. And 12 months is the new norm. If all of us were talking 2-3 years ago, we might have said 6 months. When equity was a bit more available and when there was still a lot of, there was still some transition going on. So really, I think for all of our founders, I encourage them to just understand not just the credit decision, but again, what time frames are people looking at? Are they looking only on the past and current? Are they looking in the current and the future? And a lot of times for our early stage founders, the immediate past doesn't paint a wonderful picture at all. Not because anyone's a bad founder, it's just because that's their growth story. And yet, if you know that your next 12 months are looking really outstanding, for example, if you know you'll become profitable for the first time, say in the springtime, that's the selling point, right? And to get people out of, who cares what you did in the past? My future is wonderful. And that's really the burden, is a little bit on the founders themselves in their own salesmanship to paint the very best picture of themselves.
So I'm sorry, Lisa, just go ahead.
Oh, I would just add one thing onto that. I think there is also, it's key to do a little bit of education, because even people who lend to food and bev, sometimes I think there's questions around like, oh, you're concentrated in UNFI. Like, no. UNFI is a distributor who distributes to a ton of retailers. This is not a concentration risk. So I think sometimes it's key to make sure that when they look at your financials, they're seeing the same things that you're seeing, so that story holds. And then I think the other question we often get is like, where's your contract with Target? And we're like, we don't do contracts in this industry. Like, what I can show you is an email from the buyer where she said we're launching in 1,200 doors. So that's kind of all I've got, and then that's all I'm gonna get until 2 months before launch. I'll get a PO. So I think sometimes our industry works a little bit different than some other industries.
So let's all drill down just a little bit further on this question of customer concentration. So is it a good problem to have or a bad problem to have if you have 80% concentration with Costco or Target and are going out to get a loan? Blue chip customers, but a lot of concentration. How would you each think about that based on your experience?
I mean, nobody will lend to you of a Costco concentration if they're smart. I think anyone who knows anything about Costco knows that the name of the game is a treasure hunt. You are in until you're out, and it is not a guaranteed sale. So I think concentration UNFI KE should be not concentration risks at all. Concentrations at Walmart, Target, like I think you should know those are generally, like Walmart, maybe a little bit longer on the shelf life there. Target, you could be out in 6 months. So it does vary a little bit by customer.
And Keith, how do you look at that issue when you're dealing with your clients?
Sure, a couple different ones. Folks who are lending in receivables and inventory versus bank or SBA lending on term loans and perhaps lines of credit will often view it differently. The alternative or specialty lenders are going to get it a little bit more because that's their jam, that's their focus. The banks might have some restrictions about how far they can go because they have to be perhaps a little bit more beholden to ratios or specific underwriting criteria. So that's why the specialty market that knows a lot about CPG financing, while it may be more expensive in terms of cost and particularly interest rate, it may be the place where our founders get more availability and a more day-to-day understanding of how people work. And I'll just say very quickly, with UNFI and KHE, one thing that's troublesome right now is, and we've seen it across LinkedIn and all of our discussions, is the uncertainty with trade spend and how that just varies. Yeah, Lisa, you know, right? I mean, it's hard to predict how that's going to act into the future. And you send an invoice out there for $10,000 and you're not sure what you're going to get back. And that's troublesome, certainly for banks and even for the specialty lenders these days. And I'm finding that now more than ever, this is probably the largest challenge.
And Lisa and Keith, could you talk about trade spend and what that issue is for people who don't have experience in this area?
I mean, is UNFI and KE on this call? I would say fundamentally the way that I have thought about it is that distributors get a lot of pressure from retailers to deliver the lowest possible cost. And so often distributors are not actually making money on distributing products. They are making money off of brands. They are making money off of all of the fees and all of the chargebacks. And so their incentive is to just throw everything they can at brands. I mean, we have an entire team of people that just reviews our chargebacks, and we I think we disputed over $500,000 probably year to date. Like you have to be really aggressive at it, or you will just get so many chargebacks. And some of them are like valid, and a lot of them are somewhat made up.
Fair enough. Keith, any other observations on that?
I just really appreciate Lisa's candor on that, because that's my observation as well. And it can be frightening because, as she mentioned, she's a larger company, and there's your delta, her delta and her swings can be massive. It can be tens of thousands of dollars one way or the other. And that can make a big difference between her cash availability and what she can choose to do on growth versus expenses and everything. It's a really hard topic. In fact, that's probably a good idea for an in-depth webinar, Don.
Great thought. Thank you both for that. Okay, we have a few more minutes of our regular allotted time, and then we'll get into the Q&A. So in terms of minimum annual revenue level that lenders want to see before they lend, obviously this will differ with commercial lenders and alternative lenders. But what are each of you seeing as kind of the revenue threshold that companies have to get to before they can start obtaining outside debt? And Anderson, maybe we'll start with you, since I'm sure your threshold will be a little bit higher than some of the others.
Yeah. Well, I have peers in our group that work with startup companies or smaller 1 million, 2 million companies. So the threshold is not a problem. What I will say is, the sales size does matter as far as underwriting process goes. With my team, I have more flexibility and more input. And this goes to many different banks. So that's why it's important to understand what is your banker's thresholds, because depending on the level of the company, it's more of we submit an application and then there's an algorithm that's going to look at it. To your point, if there's concentrations, they're just going to deny it. So our group typically looks at companies 5 million and more. Then we can start getting more flexible with it and having that discussion about, this concentration is actual multiple distributors. So, we can consider that. 1 million to 5 million, some flexibility, but under 1 million, it's really kind of a application algorithm that spits it out. So 1 million to 5 have some flexibility, 5 million and up, then we can really tell that story and dispute or fight some of the concerns of credit.
Thank you. And Lisa and Keith, your thoughts about where that threshold is based on your experience with alternative lenders or conventional lenders or SBA lenders for that matter.
Casey, you go first. Your knowledge is probably better than mine.
Yeah, lots of stuff here. Even pre-revenue, there is potentially debt available through CDFIs or often local institutions who have strong mission-driven, what's the best word? Well, missions, in fact, to serve communities, particularly at the startup or early stage. For all of our founders here, if you Google small business loans, and usually your state or a locality that makes sense, sometimes you'll see it in the startup. Sometimes happen to live in Miami. There's Miami Bayside Foundation, which provides loans to the community. That's at the startup. Normally in the broader fintech space, the threshold is about 250,000 in trailing 12-month revenue. That's when a lot of people kick in who are either lending for you in the retail or wholesale space or in the e-commerce space. Digging in a little deeper, the first people to show up on e-commerce lending is usually Shopify. You only need to have about $20,000 in recent sales before that starts lighting up your inbox a lot. Probably a lot of you have seen it and hit delete a lot of times. And then finally on the retail side, as low as $5,000 on an invoice is something you can use to start factoring. So that's a question of $5,000 on the AR, not a question of the total revenue, but that can happen as low as $100,000 in revenue or so. So it's truly wide ranging in that alternative and fintech space. And there are a lot of options there, plus those CDFIs and local institutions meant to support founders at the early stage.
So for those of you who are not familiar with factoring, that's a lending process against accounts receivable specifically. So no assets, no personal guarantees as far as I'm aware, but the accounts receivable will become the collateral for the loan. And that's a very specific process. Any other thoughts in that general arena, Lisa?
I mean, I would just say, like, from a personal standpoint, I found it really hard to get much done under $1 million in CPG. It often felt like a lot of lenders and investors had this, like, you're not a real company in food and bev until you're $1 million in sales, which is irritating. I think, you know, we've found that as we get sort of closer to the $10 million threshold, it feels like it unlocks a lot of options. And it's just, yeah, different lenders all have like sort of different things. And sometimes there's more or less flexibility than what's published on their website. So I think a lot of lenders are pretty open to having initial conversations. And I would just encourage like reaching out, having a 20-minute chat to just kind of understand the options a bit better.
Great, thanks, Lisa. So we have one question from the Q&A, and we just have a couple minutes left here. I think a couple others have come in, but we may be able to answer the others offline. The one question I want to get to that came in first was the question of, from a lending perspective, what is the optimal omni-channel mix from a lender's perspective? Do we have any views on that based on your experiences?
I can go first as a lender here. I mean, for us, the question is, you know, what are we lending to? When it comes to lines of credit, that becomes a little bit more difficult because our collateral is accounts receivable. So a lot of times e-commerce is cash, right? So excludes some of that collateral that we have. So how do we get comfortable with that? So that is the question. So there's no ideal. It's each company is different, and it's crucial that we understand that company story and where they're going, so that we can get comfortable with that. And there's where maybe the personal guarantee comes in and mitigate some of that collateral shortfall.
Thanks, Anderson. How about you, Keith? Any thoughts?
Yeah, I'd love to add to that. Anderson certainly points out, yeah, e-commerce is not going to have AR, it's going to have inventory. And so by nature, there are less lending options available versus retail will have the accounts receivable. Not surprisingly, accounts receivable is considerably less risky than is inventory. There's a higher valuation, you can lend more against it. So when you think about that trajectory of, if you are exclusively an e-commerce company, yes, there are less options open to you, although there are in the fintech and alternative space as well. To get to more traditional lending or even SBA lending, which will still do e-commerce, the greater amount of familiarity is in the retail sector. The other thing I think about omni-channel is channels in some ways, for some people, they really don't care because they may be focused on more that principal idea of how do you pay me back the loan is. If you're profitable, you could be 100% one or the other. Someone may be completely agnostic because they're just focusing on the cash and they're not really caring too much or place much value on the assets themselves.
And Lisa, what your experience in the lending process, was omni-channel an issue?
Yeah, I mean, I actually think they said it beautifully, so I won't add anything there. I did want to add just to the last question that came in on optimal financing path from start to exit, which is a big question for 0 minutes remaining. But my thought would be like, think about what the money is for. So for us, when we were thinking about, okay, we have a nationwide launch with Whole Foods. Like, we need to hire people, we need to do marketing dollars. Like, this is a growth. To me, that's equity. If it's like we need to build up a lot of inventory for a temporary amount of time and then flex it back down, to me, that's debt. So I often think people go to equity when they should be looking at debt. And I think, it's just worth understanding what is the money actually going to be used for.
Thank you, Lisa. So with that, I want to thank our three excellent panelists. This was a really terrific conversation. These are people who you want to stay in touch with as you proceed along your growth curve. So the email addresses have been posted on the chat. And we may have some follow-up conversations next year in this general area. Keith suggested a very good one on trade spend. But I want to thank our panelists for participating and really terrific input. Thank you everybody for participating, and we'll look forward to seeing you all at our next Naturally Bay Area Quick Bites event. Thanks everyone. Have a good afternoon.
Thanks,
John
everyone.
Anderson.
Appreciate it.
Yeah.
Thank you.